Hello, and welcome back to Explain the Charts, where we decode market movements for you. Today, September 21st, 2025, we're tackling one of the most dynamic currency pairs, EURUSD. Recent news has rocked the markets, setting the stage for some fascinating price action. Just a few days ago, on September 18th, the U.S. Federal Reserve made a pivotal announcement. They cut their benchmark interest rate by 25 basis points, bringing the target range to 4.00% to 4.25%, and signaled further easing ahead. This dovish stance by the Fed sent ripples across global markets, with European equities soaring and the euro holding at near four-year highs, briefly touching 1.1920 the day prior. However, despite this initial euphoria, the euro then saw a sell-off, reaching a low of 1.1780 post-FOMC, hinting at profit-taking or underlying concerns. Adding to this narrative is the clear divergence in monetary policy, as the European Central Bank maintains a neutral stance, with expectations for its deposit rate to remain unchanged at 2% in October. This contrast in policies typically favors the euro, as a narrowing interest rate differential makes euro-denominated assets more attractive. The US dollar index, or DXY, has also been in a steady downtrend, approaching its yearly lows, which further bolsters the euro's appeal. Now, let's turn our attention to the charts to see how these fundamental developments have translated into price movements. Looking at the daily chart for EURUSD, we can observe a significant bullish trend that gained momentum from its early 2025 lows. The pair bottomed out around the 1.01 to 1.02 region in mid-January 2025, showing strong signs of accumulation at these levels. Following this, a clear and sustained rally began, propelling EURUSD upwards for several months. Focusing on the period from March through April 2025, we witnessed a powerful bullish impulse. Candles from early March showed consecutive strong gains, breaking through prior resistance levels with conviction. Notably, on April 10th and 11th, EURUSD surged from approximately 1.0950 to over 1.1300, a massive move indicative of strong buying pressure. This multi-month uptrend aligns perfectly with growing market expectations for a dovish shift from the Federal Reserve, as investors priced in future rate cuts. Fast-forwarding to the immediate aftermath of the Fed's decision, let's zoom into the 15-minute chart. This time frame provides a granular view of the critical moments surrounding the FOMC announcement on September 17th. We can clearly see the price surging from 1.18536 in the 1749 Universal Time Coordinated Candle, accelerating rapidly to touch a high of 1.19188 in the subsequent 1804 Universal Time Coordinated Candle. This peak corresponds precisely with the post-FOMC high of 1.1919 mentioned in the news. However, this euphoria was short-lived. The very next candles show a sharp and aggressive reversal. The price quickly plummeted, suggesting intense profit-taking and perhaps a buy the rumor, sell the news reaction. This rapid decline from the 1.19188 high marked the beginning of a significant short-term correction. Expanding our view on the 15-minute chart from late September 17th through September 19th, we observe the continuation of this downward momentum. After the initial spike and reversal, EURUSD continued to trend lower, stabilizing briefly around the 1.1810 to 1.1820 region. However, selling pressure resumed, driving the price down towards the 1.1780 level by the end of September 18th, consistent with the news reports. By September 19th, the bearish sentiment persisted, with the pair closing around 1.1745, establishing this as a new immediate support test point. This immediate post-FOMC reaction indicates that while the long-term fundamentals might favor the euro, short-term traders reacted by taking profits or initiating fresh short positions. Let's take a quick look at the 1-hour chart from earlier in September to provide some context on prior stability. While this data does not capture the recent FOMC event, it shows that EURUSD was generally trading within a range of 1.16 to 1.17 during the first few days of September. There was a notable dip on September 2nd, but the price quickly found support and resumed its consolidation, indicating some underlying strength even before the Fed's decision. This helps us understand the market's state leading into the major news event. So, what does this all mean for EURUSD moving forward? In the short term, the market is likely to remain volatile as it digests the recent Fed decision and searches for new equilibrium. The immediate resistance to watch is the 1.1919 high, a level the price struggled to maintain post-FOMC. Key immediate support levels are 1.1780, the post-FOMC low, and more critically, the 1.1745 close from September 19th. A breach below 1.1745 could see the pair retesting stronger support zones around 1.1600 to 1.1650, which served as consolidation areas in June and August 2025. For the long term, the bullish fundamental backdrop, driven by the Fed's dovishness and the ECB's neutral stance, remains largely intact. Should EURUSD break above 1.1919 on sustained bullish volume, it could realistically target the 1.20 level and potentially extend towards RBC's 2026 forecast of 1.24. However, upside potential might be capped if U.S. inflation data continues to rise, potentially forcing the Fed to slow its rate-cutting cycle. Conversely, if the Eurozone economy shows signs of weakness, the ECB might be pressured to reconsider its neutral stance, which could undermine the euro's strength. Traders should closely monitor upcoming economic indicators, central bank communications, and especially any shifts in inflation expectations. Look for clear candlestick patterns around these key support and resistance levels on the daily and 4-hour charts for entry and exit signals. Also, pay attention to trading volumes, as high volume on breakouts or breakdowns can confirm the strength of the move. Remember, predicting market movements is inherently uncertain, but understanding these dynamics can give you a significant edge. Thank you for watching Explain the Charts, and happy trading!